10 student. So my name is Ali, and today I'll be going over Matt Pugsley's interview that he had with Professor Abramson. So keep in mind that this video has been done while being in quarantine or containment. So if you hear my mother yelling at my little brother, please don't mind that. And so let's dive right in. So Matt was a fellow Concordia student a couple of years ago, or maybe a long time ago. He studied finance, he went on to pursue a CFA certification and got a couple of internships. One of them was at the Montreal Stock Exchange. That's where he got his first hands-on experience in finance, and that's what sparked his interest. And a couple of years later, he found himself being a microcap investor, and I'll dive right in to explain what that is. So microcapitalization stocks are characterized by a couple of things, and the first one being these firms' capitalization is ranging from anywhere between 30 million and 350 million. So these makes them somewhat small, very small companies. And also it's characterized by inefficient markets, meaning that these small companies fly by under the radar and institutional investors don't even mind them because they're very illiquid and their trading volume is very low. Meaning that if investors decide to get in, since the trading volume is very low, they don't know when they can get out of that position. This is why the investment horizon is long term. You get to see the firm grow and see it through its ups and downs, and you have to stick with it. And so basically the idea behind microcapitalization investing is to buy tomorrow's large cap stocks, but today, which when you think about it makes sense because all of the big companies that you see listed today on the exchanges at some point were much smaller firms or even micro firms. So if you can get on early enough, you will see a reward maybe 3, 4, 500 times. Starting 410 concepts apply to the real world. Based on Matt's conversation, I understand that they do use discounted cash flow and relative valuation, but they use them as confirmation tools rather than primary tools. Because these methods have downsides, and the main one is that if you go in with biased assumptions, your valuation will provide you with biased results. So in general terms, valuation can be manipulated. I got to experience that firsthand with my own valuation. I was very excited about the stock that I picked, and I had bullish expectations, and that got reflected in my assumptions and again in the valuation output. And so Matt came up with a pessimistic approach to valuation where he uses a high discount rate, so on average 10%, along with a very low growth. So he generally uses GDP growth rate, which usually goes between 2 to 3% all the way up to 4 to offset these kind of negative effects. And so that's why he says that valuation is a combination of arts and science, because there's this part of arts where you have to use your judgment and be able to distance yourself from your emotions, and the science part comes down to the financial metrics used for the valuation, which will be my next topic. So financial metrics are very much used in microcap investing, because microcap investing is the closest thing that you have from private equity investing, which is basically investing in private firms. So in order to do that, you need a very core understanding of the business and the business model, and you have to also use financial metrics to understand the financial health and the growth prospect of the company that you're trying to value and purchase stocks in. So regarding some of the metrics used in the microcap sphere to evaluate companies, the first metric we're going to be discussing is the free cash flow yield. So this is a solvency ratio used to evaluate if, after all of its capital expenditures, net working capital changes, as well as non-cash expenses, such as depreciation, is the firm able to satisfy its debt obligation as well as provide a good dividend return for its various shareholders. So this is an important one used to evaluate if a firm is in good financial standing and is in general good financial health. Another important metric is the net asset value. As explained in the formula, it's fund asset minus fund liability, which is in this case applies to a firm. So firm asset minus the firm's liability. And this is to see if the firm is able to immediately take care of its debt obligation, as well as what is left after taking care of all this debt obligation. Is there something left to redistribute to shareholders? And this is especially important in the microcap sphere because these stocks are so overlooked by the market that some stocks are trading below their net asset value. So even if in the long term they do not realize their true value, they're still able to have that cushion between trading below net asset value all the way up to realizing their net asset value. So another very important metric to consider when not only evaluating microcap stocks but also regular stocks is the EV to EBITDA multiple. So it's an enterprise multiple, and there's a question that arises, which is why an equity investor would use a firm-based multiple to value equity. It doesn't make sense, but it's very simple. It basically just takes into account the capital structure on a tax-neutral basis. So different firms have different leverage levels and different tax rates. So the EBITDA normalizing factor takes the earnings before any kind of interest, taxes, depreciation, and amortization. So it helps to have a general picture before all of these different factors come into play. And which is why EV to EBITDA is one of the most widely used multiple in valuation nowadays. And so on to our next topic, catalyst and selling decision. A few factors will come into play when a microcap investor decides to let go of his position. As Matt previously mentioned, the investment horizon for a microcap investor is very long term, so anywhere between 8 all the way up to 15 years. So you get to see the firm grow, you get to see the firm throughout all of its cycles, which makes it all the more harder to close a position. But there are a few factors that will make things easier. For example, takeover and acquisitions are automatically a forced sale. So when a company buys out your company, or within the firm you decide to go private, the investor has no say in it. So that makes things easier for them. Also, when a microcap stock realizes their true long-term potential. When that stock transitions from being microcap all the way to maybe small cap or medium cap, it gets acknowledged by these institutional investors. So attracting the big money will make it more attractive, which will along bring more speculation, which will drive its value upwards. So this is an indication that it's time to get out of that position, because when speculation comes into play, it makes things much harder to analyze long term. So this is an indicator that it's time to get out of the position, and it's an easy sell then again. And also there are a few firm specific risks where you can see that the firm has a bad management or bad capital allocation, or a change in management might shake things up. And all of these different factors will basically trigger a signal for the investor to sell their position. Now onto the micro cap market. A couple of important considerations when investing in microcap stocks. The first one, and one of the most important one, is that microcap stocks tend to follow their own market trends. Now, I'm not trying to say that they are negatively correlated with the market. It's simply that at times they will behave a little bit differently. And that is because these stocks and that specific segment of the market is overlooked by institutional investors as well as retail investors. And so there's been a hype or some kind of a rise in ETF and passive investing over the past couple of years. And for those who are not familiar with what that is, there have been some index funds that are only tracking the big indicators in the market. So the S&P 500, the Dow Jones, the TSX for Canada. And these big funds are comprised of medium and large and some small cap stocks. And when the market tumbles due to corrections, recessions, or even black swan events like one that we're living through right now, these big index funds tumble due to the underlying stocks that drive their value. And so when that happens, the microcap sphere becomes much more interesting to investors because, as I mentioned, they follow their own trend at times. So when these big corrections happen, the money from institutional investors will flow back in the microcap sphere because they're basically a hedge against market corrections. And that's why it's so interesting. And that is one of the main reasons why Matt got interested in these specific stocks. And so, a closing note. So, microcap investing and investing in general is a discipline game. That was a common theme throughout the interview with Matt. So, when investing for the long run, you have to stick to your initial strategy that you've implemented. It's very tempting to trust your gut feeling during economical downturns, but ultimately you have to stick with what you know because the second that you step out of that bound, it's very hard to predict what's going to happen. So a strategy is your best ally and the one that you're going to reap the most return with. So I hope you've learned something from this presentation. Thank you very much for listening to me and stay safe.